can tell you with 100% certainty that we're either in a bubble or this will eventually be a bubble. But I can't tell you if prices will, if we're near a peak, or if we're gonna find ourselves in a place where prices ultimately end up lower than where we are today. I'm convinced that all these players will overbuild, and there will be write-downs. This is not me guessing. This happens 100% of the time. One of the most popular figures and phrases to come out of that whole dot-com era was Fed Chair Alan Greenspan questioning this possibility of, but how do we know if there's irrational exuberance in the market? If you had sold out completely of the market when Greenspan said that, and then perfectly timed the bottom in 2002 and bought then, you would have actually lost money.
You're watching Excess Returns, the channel that makes complex investing ideas simple enough to actually use, where better conversations come from better questions. Kai Wu from Sparkline Capital, he's co-hosting with me today, and our guest is none other than Ticker's own Sam Rowe. Sam, welcome back to Excess Returns.
Thanks for having me.
So we're jumping right into the deep end here. We're talking market valuations, and before we do that, are valuations even useful anymore? Does anybody care? Can we just throw them all out the window like a White House press conference? Can I get some Kalshi odds on this? Does it matter? Should we even be having this conversation? Can I go home?
Absolutely. Absolutely that they matter. Having said that, I think the way to think of it is they absolutely do matter, but there's caveats to that perspective. Or we could say they don't matter, but there's caveats to that perspective, right? Like understanding what valuations actually tell us. Well, it tells you the premium you're paying for a company's earnings, or if you want to get really into the theory, the future cash flows, the net present value of the future cash flows of a particular company. The challenge there being, well, what is this company going to earn? Not just this year and next year, but into the rest of its existence. How is this company going to actually be in existence, 30, 50 years from now? That's where things begin to get a little bit treacherous in terms of things like valuations and how much weight you want to put into those things. But in terms of using that information as something that's actionable, the history tells us that it really depends on your time horizon. If you're trying to time a really great entry point or something, valuations are probably not going to help you because they won't tell you, or historically there's very little reliable signal when it comes to where prices will be, over short-term periods like 1 or 2 years. So you can have elevated valuations where prices continue to go higher, but you can also have low valuations where you think that might be a good time to buy, but prices actually sink further. So I think in the context of maybe longer term thinking, you might want to put more weight into valuations, but otherwise, don't be disappointed when the market doesn't do what you thought the valuations were telling you they would do.
So what I'm hearing is valuations matter over a longer time frame, but on any given day, who knows? It's not a meaningful signal.
Yeah, and I think the other thing too is, maybe at extremes and maybe at like the stock level, things like PE ratios, right? It's very simple what those ratios are telling us. The price you pay versus for 1 year's worth of earnings. So if you're paying 20 times earnings, then you're making the assumption, or you can extrapolate that you can get your investment back in 20 years, assuming earnings go sideways or something. And so 20 or 18 or 20 versus 22, it's like if you're a business owner and you think about it in terms of that, this is a rounding error. It's great that you made your money back in 18 years versus 22 years. Or, let's say it takes 22 years to make your money back instead of 18. Well, that's not the end of the world either. So I think in terms of like long-term investing, What we off like 90% of these debates with valuations is mostly about things like, is 22 too high relative to a historical average of 17, or is 12 now attractive relative to historical average of 17? From my perspective, I think it's a good discussion to have, but from my perspective, I think we're sort of um, dealing with what ends up becoming a rounding error over the long run. But yeah, if we're talking about a 1 PE versus a 200 PE at those extremes, then I think, yeah, let's actually take a closer look at what we're about to buy, because you might not want to buy at 200. And, I don't know, maybe it's like at 1 PE, but the company's finances are really great. Yeah, maybe you buy the whole damn company.
So you mentioned a 22 PE relative to a 17 historical average. Well, so it turns out that that's exactly where we are today. So entering this year, the S&P 500 forward PE ratio sitting at 22 times earnings against a 30-year average of 17.1. And so I'll put this chart up as well for the viewers, but we can basically describe this, in one sentence, which is we are currently sitting over one standard deviation above that historical average of 17 times. What does this tell you? I mean, you have, plenty of folks on TV saying, oh yeah, this is one of the most expensive markets in history. Do you agree or disagree? What are we missing here? What are these guys missing?
Yeah, I mean, I think it's a good place to start a conversation about value in the market. It certainly shouldn't be where discussions end, right? You shouldn't end with whether or not you're going to buy into the market or buy into a particular stock because of the PE ratio. I think you start with the PE ratio and then try to figure out, well, what else is going on here? And something that is being increasingly, I think, appreciated in the analyst and the strategist community is this idea that, well, it's not just sort of the mix shift of the makeup of the stock market or the S&P 500, but across the board, we're talking about companies where structurally they're seeing things that are very different today than what we might have seen 7 or 8 years ago or 15 years ago, or however far back you want to go when it comes to calculating what these historical means are. And broadly speaking, you have better operational efficiencies and operating margins. The financial structures are much more healthier, with companies with much better credit quality. And then there's things that are sort of even external to the businesses themselves, like just the business environment, broadly speaking, like, being able to conduct business, over cameras and webcams. Think about how much productivity we would have lost if, we all had to meet in one place to record, do this podcast. That's productivity that is no longer being lost. And I think we take that for granted when it comes to everything that happens in business, right? So maybe just the very fact, like, let's say, for instance, operational efficiencies and credit quality and all that stuff has actually been fixed for the last 30 years. Well, little things like this that we're doing right now, where the business environment and the available apps and the internet and all these things make us that much more productive, must therefore justify a higher premium we're paying for our earnings and cash flows. Which, by the way, that in itself is very much rooted in theory. Things like, higher return on capital very much justifies things like higher premiums that you should pay for a business when you go shopping for investments.
Well, before we assume too much economic value in this podcast, which I assure you, we're all making lots and lots of money on in the private jets that would otherwise put us in person, are there somewhere. I'm sure if we just study the accounting. And to be fair, a big part of this conversation came out of your piece, 27 charts to consider as we look forward in the stock market. So we're going to pull more of these charts up, but make sure you check that out if you're watching this online. the next place I want to go is related, because it's the ultimate and what I think higher valuations are supposed to come from and where there's supposed to be mean reversion, and that's profit margins. Like, is Santa not coming this year? Santa profit margin compression, Sam? What's going on? This one really gets at me, and I think it gets at the core of the technological revolution that you were just hinting at before. But what the hell is going on with profit margins?
Yeah, I think there's a couple of things, and it's definitely not one thing. It's definitely not just tech. It's definitely not necessarily just price gouging or whatever you want to call it. It's definitely not just companies squeezing more out of the few workers that they have. I think it's a combination of all those things that we're seeing right now. But yeah, to the point about elevated profit margins and us, waiting for those cows to come home, and why aren't we seeing some reversion to some historical average? I do think that while we haven't seen it, I do think that there is some merit in understanding that that could be a risk, right? Like, we live in a competitive business, an extremely competitive business environment, and one of the easiest ways to compete against one of your peers is to undercut them on price while delivering something similar, if not marginally inferior. I don't know, but yeah, this has been the question that we've all been wrestling with for at least 5 years. Coming out of the COVID pandemic, there was this issue with supply chains, and inflation was starting to creep up, and there was this idea that with cost inflation, profit margins would inevitably get crushed because companies would not be able to pass off 20% increase in egg prices or whatever to their customers. But much to everyone's surprise, they were able to pass those costs on, and the customers absorbed it. Now, what's going on here? I thought we were in a competitive society and all these things, and like, if people shouldn't be willing to stomach those price increases, but they did, and they knew they were coming, and they responded to the consumer sentiment surveys. They voted, and they all expressed outrage to all these higher prices that were passed on from these companies who had these really big, gigantic, fat profit margins. So, what are we to make of that? For me, I think central to why that sort of counterintuitive phenomenon, happened, and why it continues to happen, is people have money. It is still the case that household finances, some people are doing better than others, but in aggregate, household finances still continue to be very strong, if not healthier than they were, pre-pandemic. And there's the same thing with a lot of businesses too. Balance sheets are much healthier. Companies have a lot more cash. A lot of this stuff is normalizing, but in recent years, they've been unusually flush with cash and have had very little leverage, which actually goes back to some of the stuff we were talking about with valuations, right? Financial resources have not to mention the fact, low interest rates and all this kind of stuff. So yeah, I think it's as simple as, an important part of this equation is that, consumers and businesses have had money to absorb the higher prices that companies have been passing on. And so I think that's a very important part of this profit margin story, which is to say that, maybe this is the year that maybe things go sideways with margins, or maybe that they contract. But we're also entering the year again with finances, household and business finances, generally quite healthy. So yeah, again, this is, I basically start every year with this sort of same discussion where it's like, I think this could be the year where people start to rein things in. But I'm like you guys, I follow the data, and the data is saying that people are still spending.
So this is kind of the trillion-dollar question, right? Because if valuations are premised on elevated margins and being structurally higher, the question of where margins go will be kind of a double whammy. Should they mean revert? So here's kind of the question then, which is, we talked about the pandemic, which obviously is starting, kind of subsided by now. The next big trend in the economy, of course, is the AI revolution, right? So you have folks who are saying, look, like this AI technology is game changing, and surely that will have an effect on margins, whether it's through the kind of labor versus capital imbalance, the competitive landscape amongst big tech and other, previously kind of monopolistic, oligopolistic market structures, around efficiencies potentially to be gained. You mentioned like the mix shift of companies as kind of technology has eaten the world. Profit margins have gone higher. So, there's a lot of things I just brought up here, but, I'd be really interested in your view, Sam, on how you view AI kind of coming into play on this $1 trillion question.
Yeah, it's a $1 trillion question that's got lots of issues that where it's also very incredibly difficult to measure this in a very comprehensive way. And I'll be very clear, like in a comprehensive way. I mean, historically, it's always been very tricky to try to measure or even define, what productivity is. But as someone who is mostly focused on the stock market, I don't go out there and do economic policy, and I don't write an economic policy. I write a stock market newsletter for people who are long-term investors in the stock market. So, the North Star, again, like, sort of what we were talking about earlier, is earnings. And then if we're talking about corporate earnings and company earnings, we have to go back to the conference calls and the individual earnings reports and the 10Qs and the 10Ks to see what the companies are actually saying at that ground level. And the anecdotes so far is I would actually say that characterized as mixed, in that a lot of companies will give you really tangible examples of how AI has materially increased productivity and improve the performance of their operations and all these kinds of things. And then there's others that are saying that, we're still exploring, or we're training, and we're trying to figure this stuff out. So I think it's still pretty early to understand exactly what this looks like. I think in theory, everyone wants to say that this is going to unlock a lot of productivity. It's going to be able to convert a lot of man hours into robot hours, or whatever. And I think that side of it makes sense. But yeah, it does come down to like how the economics of this thing actually work. Because this stuff isn't free, right? I mean, some people are using the free versions of ChatGPT or whatever to, write memos and things, but the enterprise version of this stuff is not, isn't free. And there's no reason to think that things will continue to be free and or cheap for a very long time. Like, at some point, I think these AI companies are going to start saying, oh, you really like this product and you've unlocked $100,000 worth of productivity last year. Well, we're going to raise the price of this thing from $20,000 to $50,000 a year. And it's like, how does that look? So I think from like a top line perspective, yes, we may be able to see productivity unleashed, but in order to really understand the economic value of that productivity, we have to understand how those costs are going to evolve. So yeah, it's an open question. I'm bullish on the possibilities and the technology, but I do think it's an unanswered. The two unanswered questions are: to what degree do you get productivity? And two, what do the costs look like, over the long run?
Embedded inside of this is what parts of these profit margin increases are structural. And you had this really great chart from Truist that I think is fascinating. I'd love to have you unpack it. It's basically valuations are less extreme when you adjust for structurally higher profit margins. What's going on in this image?
Yeah, so this actually this is basically tying everything we've just talked to together, right? Looking for an explanation as to why things like PE ratios are more than a standard deviation above their historical average. Well, you know, how many standard deviations above historical average are operating margins and net margins? They're elevated. And so there's a, you look at a chart like this where, at least over like the, past 10 or 15 years, there's this upward trend when it comes to things like profit margins. And, there's a lot of noise along the way, but, valuations have been trending higher over this period too. Now, of course, we can also talk about things like interest rates and all these things over this period, which of course contribute to net margins. But the bottom line being that there is, this, seeing profit margins trend higher helps you understand why you have higher valuations. Is it an actual structural thing? Or is it just sort of, a 15-year, because that's another thing too. It's like 15 years is very much, feels secular and structural, but like, maybe 30 years from now, we realize, well, that was actually an anomalous period. I don't know. But for now, I do find it satisfactory that, valuations have been increasing alongside profit margins.
And so I guess the next question relates to kind of the questions around composition, right? We're talking about the U.S. market, which of course has become increasingly tech dominated over time. And, one of the things we've seen is that tech companies tend to trade at premium multiples relative to their non-tech peers. So the question is this, which is, to what extent is this justified? You actually have an interesting chart here showing PEG ratios, which I believe adjust P ratios for expected growth. Can you maybe walk us through what this is telling us and, why this may or may not justify the kind of higher multiples at which tech companies tend to trade?
Sure. So, so this chart comes from J.P. Morgan's Michael Sembalist, who, adds one more dimension to this PE ratio discussion, which is extending out that earnings forecast by an extra year and saying, because when we're talking about, 18 PE versus 20 or 22 PE versus 18 average, we're actually only talking about based off of 1 year forward EPS estimates. This one adds 1 year, and it's an average of 2 year forward EPS estimates. And when you have 20% earnings growth followed by another 20% earnings growth, maybe it makes sense to think about, those sort of stacked earnings forecasts. And so what he's showing here is that when you do look out a little bit further with what the expectations are for, let's say, 2027 earnings, then the valuations do become more rational because it looks like, like what we were talking about before, it's going to take 22 years to earn back 1 year's worth of earnings. Well, if the year after next, the earnings level is much higher, then it's going to take far less than 22 years to earn back that earnings. But as with everything, there are caveats, right? As much as this helps us understand why valuations might be elevated, we also have to understand that when you're forecasting 2 years out, there's a lot more uncertainty. Like, we don't know what's going to happen next week. And now we already put so much faith in what happens on 1 year's worth of earnings. And now with a measure like this, which again helps us understand, why we're trading at a premium, we also understand that there's going to be that much more uncertainty attached to the measure because we're now forecasting earnings that we won't know about for 2 years.
So we love banking on things that aren't here yet, which is a very short way to say, what's your thought on bubbles? What's your thought on the AI bubble question? Is that even a question worth asking in the face of just, you're couching the whole future as uncertain, as you should. Sure. But is that bubble question even fair?
Yeah, I think it's totally fair. And I think it's also, the only reason why I don't like talking about bubbles per se is as soon as you say it, it invokes certain memories and imagery in people's heads.
They all go to
And
tulips right away. That's the
They all go to tulips, but
babies and
some go to
tulips.
some go to tulips, some go to South Seas,
Yeah.
some go to .com, some go to, depending on their age, they're going to look at, crypto a couple of years ago. And I think that's an important point, right? Everyone sort of defines what a bubble is differently. And so I think from that perspective, it's not helpful to start by saying, are we or are we not in a bubble? I do think that history tells us that when there is something exciting happening, when there appears to be a big paradigm shift, whether it's technology or whether it's industrial uses for certain things, or maybe a new pharmaceutical or something happens, there's a lot of excitement, and when there's a lot of uptake, and by the way, everybody from age 3 to 80 are telling you different ways that they're engaging with AI. When you have this kind of excitement, I think it's inevitable that you overshoot when it comes to things like investment activity and valuations and all that stuff. So my view is I am very confident that we will get to a place that in retrospect will be defined as a bubble, because we know that the prices shot way beyond what was actually a justifiable valuation. Problem is, and this is the other trillion-dollar question, is when is that going to happen? And we just don't know, especially when we're thinking about stuff that's going to upend a global economy with 8 billion people and tens of trillions of dollars worth of economic activity. And all these numbers that we hear about every day about like capex investment and all this stuff, it's all mind-boggling. But when you begin to normalize things with the potential impact, it becomes much murkier. But of course, that's the kind of language that someone who's hyping this stuff will say. But the last thing I'll say about this though is the problem again is we don't know how to time any of that stuff. Like I can tell you, let me actually put it this way. And this is one of the lessons from the late '90s, by the way. One of the most popular figures and phrases to come out of that whole .com era was Fed Chair Alan Greenspan questioning this possibility of, but how do we know if there's irrational exuberance in the market? Whether or not he was talking about a bubble specific, I don't know, but people go back, even looking at history in retrospect, will point to that as a sign. But what people sometimes forget is the market continued to go up for 4 years after he said that. And when the market eventually bottomed, 2001, 2002, or whatever, post-bubble, the S&P 500 at the low then was still higher than when Greenspan made that statement. So if you had sold out completely of the market when Greenspan said that, and then perfectly timed the bottom in 2002 and bought then, you would have actually lost money. So it speaks to this whole challenge of like this timing. And listen, it's great that people want to try. Listen, we're not always talking about all in and all out, right? Maybe you take some risk off, take some profits off or whatever. But the point being is we can both agree that we're in a bubble, but also agree that it's going to be incredibly difficult to time how this bubble works. Because it's not just about selling during a bubble, but you also, if you're a long-term investor, you also have to figure out when to come back in. So that's two incredibly difficult decisions you have to make.
In the forthcoming DeLorean ETF suite, we're adding the 3x reverse Greenspan trade in honor of Sam Rose.
I'm sure we'll find demand for that one.
I'm sure we will.
So it sounds like you think that euphoria is kind of a part and parcel with any technological revolution. Yet the challenge is that knowing in real time if you're in a bubble, and it's even just unclear what the intervention might be. So let's put aside the kind of price action bubble discussion for a second, and instead focus on the real impacts of this technology, right? where would you rank, and this is maybe an unfair question, but where would you rank AI relative to the other inventions of history, the internet, electricity, the automobile, so on and so forth, in terms of how you anticipate it transforming the economy? Right? You have your folks in Silicon Valley saying this will be the last invention, that it basically this will obviate the need for human labor. That's obviously an extreme view, and they're talking their own book, of course. But I'd just be curious when it comes to the real productive impact of AI, putting aside kind of any of the questions of whether shareholders will make money or not. Where do you think this ranks?
I think it ranks maybe it's like kind of a cop out, but I do think it kind of ranks with the internet. Actually, let me change that a bit. I'm sort of thinking on the fly here. Maybe we go back to automobiles, because you know what? Automobiles replaced horses, and there was a whole horses, horse-drawn carriages and all that stuff. That used to be pretty big business. There used to be a lot of horses that took people around, and there were a lot of businesses that supported horses. Everything from blacksmiths, making horseshoes, and cobblers, and people baling hay and cleaning up shit on sidewalks, all day long or whatever. It's incredibly disruptive, and that put a lot of people out of work. I mean, my goodness, like that entire, think about all those attached industries. But then, yeah, you had the uptake, and then, and not to mention, speaking of bubbles and overshooting, there were hundreds, maybe even thousands of automakers in the wake of that, the whole dawn of that paradigm shift. And then, of course, there were some winners and losers or whatever. Yeah, I think maybe that's it. But in terms of like the sort of like the nature of the transformative impact, I think it's as simple as when you do think about what does good tech or a good technological development really offer. I think fundamentally it has to be some combination of it makes something we have better, or it makes something we have cheaper, or it makes something we have faster. And I think when you start to think of things in terms of that, people who write, interoffice memos, love these chatbots and stuff who will draft a memo for them in 30 seconds, as opposed to them having to, work this from scratch for, 45 minutes or an hour or something. Every lawyer and paralegal on the planet will tell you about how this is absolute miracle. If they're not telling you that, they're lying. Like they understand how this stuff works, and it is changing the way people who work on paper are doing business. I'm definitely not convinced that it just replaces all people, because there is some intangible value that people have to offer when it comes to, I don't know, whether it's the sale of a product or the delivery of information, or, something else people are looking for when it comes to the interaction that the AI might be replacing. So I don't think this is the end of people. But I definitely do think that it does replace a lot of work that used to be done by people. Like an example that that the analogy or example in media is often, or the first sort of skeptical take is, well, hey, wait a second, we can't trust a robot to report out a story and write an article and send it out. Who's fact checking this? Who's quality controlling this? Who's going to confirm that these sources actually exist? Well, here's the thing. AI doesn't have to be perfect, right? AI doesn't have to be good at any of those things, by the way. It just has to be better than what you have. And with entry-level reporters, or even experienced reporters, you have an editor who does have to do the fact checking, who does have to this reporter has to earn the trust of this person to know that these anonymous sources actually exist, and all the things that should go in vetting the work of whatever the AI is replacing. So all those steps will continue to exist, but the difference between the human reporter, the junior writer or whatever, and the AI is AI will file the copy in 30 seconds as opposed to, the junior writer who might take 4 hours, 6 hours to put this draft together. And it's the same thing that you have to go through the same rigorous editing process in. So, and there are examples of this, across the board where it doesn't, fully solve all of your problems, but it does certainly save you time in the process of doing things that are, the normal course of business.
Inside of this, there's a lot of money being spent on AI by these companies. And I do think it's interesting, especially taking it back to the bubble analogy, of these companies are not only just spending absurd quantities of money as investment, research and development, CapEx spending, and then expensing it off. How do we reconcile if this is ever going to be worth it, or go, oh no, this is thoughtless spend that's happening right now?
I don't know. I don't know.
That's probably the right answer. But,
yeah,
but how do you even think through that? Because I mean, some of these numbers are
I
insane.
think the starting point. I think the starting point is appreciating that this isn't like pet rocks or something where it's very difficult to see the tangible value that you get out of what you're investing in. All this discussion about replacing, man hours, which cost a whole lot and come with health insurance and all these things, you can begin to measure that stuff out. What's really tricky is, actually nailing, what that ultimate productivity and the value of all that looks like. I'm not sure anybody who was working on the internet in the late 90s understood where we would be today in terms of what that technology has offered in terms of the value add. And there's good and bad things that have come with all this, but it's like I think the point being that we it's just so hard to envision what things might look like 10 years from now. But as far as like the spend, there's some companies that are sort of at playing around in sort of treacherous financial debt territory a little bit more than others. And then there are some of these bigger companies that are financing almost all of this with their, free cash flows from their existing businesses that are already massive. Whether that turns into some big, credit event that ripples through the markets, I don't know. Maybe that's not what we're talking about right now. But in terms of the economic value of like all this CapEx spend, I don't know. I think we see it in hindsight. I do think though that a lot of the folks who are working on this, whether they are at Google or Meta or Amazon, a lot of the maybe the engineers themselves weren't around back then, but they're coming from a culture that was established during this period where they know that if you can win. Whoever wins in, 99 or 2000 or 2001 will dominate for the next 20 years. And, you go from, think about search engines back then. Like, think about all the different search engines. Like, I'm starting to forget some of those, but like
Ask Jeeves,
Lycos, Ask Jeeves, yeah. Alta Vista. No offense to one of my former employers, but I mean, even Yahoo was massive back then and had a huge valuation. And then a couple of years later, everything gets blown out by Google, and then Google just keeps improving on their product, and they never stop improving on their product. And they add all different things alongside whatever that search was, and they figure out how to monetize it better. And now we're talking about $1 trillion companies. And so I think that's what people see at stake here is not just the AI, but there's going to be all kinds of things that are going to be attached to the AI and the software and the services that come about here. But maybe it's not winner take all, or maybe you don't have to be number one, but you definitely want to be out front. And the way to do it with any kind of investment is you got to throw a lot of money at this thing.
So Sam, what I'm really interested in understanding is how we see the value of AI accruing through the value chain, right? Because obviously the AI ecosystem is not a monolith. There are data center companies, hyperscalers, chip makers, RAM producers. There are the electricity component, and then there's the users, the adopters of technology. Now, one interesting thing we've seen, when we study historical episodes like this, think about like the railroad build out in the 1860s, right? There are hundreds of railroad companies built that were founded in the U.S. Most of them went bankrupt. In the dot-com boom, right? The telecom index, these telecoms like Global Crossing, AT&T, spent billions of dollars building out the fiber optic infrastructure for the internet. That index, the telecom index, went down 92% and has never recovered. Even today, it's still below its high watermark, right? So one of the interesting patterns you've seen historically is this kind of irony where the guys who are actually building out this infrastructure, who are kind of building the future, literally, they are the ones who do not actually capture the value of their creation. Instead, it's the users, right? The fact that we all get to enjoy subsidized AI inference,
Right.
or the enterprises, right? The customers of these infrastructure builders who have actually stood to benefit, right? And that's just a historical pattern. Maybe this time will be different. But I'm just curious. We talked a little bit just now about the competitive dynamics amongst big tech, where these big tech leaders view the market as winner take all because of their experience in the cloud and mobile and the browser wars, so on and so forth. And as a result, they're willing to commit insane amounts of money with the hope that they will lock up the market, right? Like, does that kind of game theory dynamic potentially lead to an overbuild, potentially lead to a situation where there's too much capital at the infrastructure layer, and maybe the profits don't end up there, that end up becoming commoditized, and instead they flow down to the users of this kind of subsidized infrastructure, the Netflix, and Facebooks who benefited from the cheap bandwidth, that happened due to the stranded assets in the dot-com bust. What are your kind of thoughts on this argument? Which I think people are increasingly making.
Yeah, I think that makes a whole lot of sense. And sort of following up on what we were talking about earlier. I think there would be tremendous overbuild. I think there's going to be it's going to be sad, but there's going to be a lot of idle, empty data centers and stuff gathering dust because we totally overshot. Maybe it gets used eventually. But yeah, I mean, I think that the promise of this from an economic standpoint, and this even outside of the hyperscalers, the reason why there's this much excitement and the reason why there's putting this much money into this is because of like the far-reaching second order, secondary benefits, right? The users, like you're saying. The only reason why I would be excited about any of this is not because of how much money I want to make investing in Mag 7 stocks. The reason why I'm excited about this is because I think that my S&P 493 should do incredibly well here. And again, anecdotally, across industries, people are talking about unlocking value from using this technology that they're already deploying. There's a lot of experimentation, but a lot of these places are already deploying it, and some of it is starting to show up in labor market data in terms of how hiring and all this stuff happens. But yeah, to your point, listen, there's a very large graveyard of companies that were once the hottest thing on the planet and, maybe moved into these sort of paradigm shifting areas where, the secret to being number one was to build and build and build until you reach the point where you realize, you're the roadrunner that ran off the cliff or whatever. I'm never going to rule out the possibility, because history always repeats this, by the way. I'm not going to rule out the possibility that, that some, maybe all of the mega cap tech companies we're talking about today, might not be around in 10, 15, 20, 30, 40. I'm going to keep increasing that number in 50 years. I don't want anybody smart yell at me if they're still around in 5 years. But that happens. And it's like in order to keep, I mean, because if there's one thing that investors want, and the executives and the shareholders and the board and all these people want from any of these companies, to see that perpetual earnings growth and the cash flow growth or whatever. And as long as there's going to be demand for that, they're going to keep pivoting in directions where they're going to see, that next, the next year or two's worth of growth or whatever. And then maybe eventually it leads them to a place where they can't come back and, they become obsolete. Or, the product that they help develop becomes commoditized and they no longer own the rights to it. Like a pharmaceutical company that, loses the patent on, the multi-billion-dollar drug, and they have to find something else. And if they don't, they end up going sideways and all this kind of stuff. So yeah, I think that's a very real risk. And, this is why I preach things like the merits of being very broadly diversified. Even when you have confidence in who the market leaders are, and when you see those, 2-year earnings growth forecasts are much hotter for certain places, but, maybe that just means it's a good time to be in, stocks that are outside of that category. But yeah, to your point, I would never, I'm convinced that all of these players will overbuild, and there will be write-downs. This is not me guessing. This happens 100% of the time. There will be write-downs because the ROI for something that they invested in doesn't deliver, and it becomes an impaired asset, or a factory needs to close, and all these kinds of things. And we're gonna hear about, it's just a non-cash write-off, blah blah bullshit, whatever. But yeah, I think that'll certainly happen. That's just the nature of when we have interesting things happen when it comes to technology and innovation.
So another piece that's fascinating here, Sam, and I want to bring up this chart from B of A. S&P 500 revenue per worker. How flat this was for 15 years is really interesting to see. But B, to what you're talking about, like driving earnings, a big part of driving earnings is driving growth, and actually seeing the revenue per employee revenue growth increase now for the first time in a minute. This feels pretty optimistic. This feels like a good case.
Yeah, it's great. I mean, as an investor in companies like this, I think, you can't help but be thrilled. Of course, all things being equal, right? Hopefully you're not burning more cash on something else to make this happen. But, your employee headcount is usually, one of, if not the most expensive thing in your cost structure. And so to be able to get more revenue per worker is a great thing. Because, again, everything from all the tools, whether it's the internet and Google Meets and all these things that help us be more productive. Yeah, I think you can't be anything but optimistic. And there's really no reason to believe that this is going to go in an opposite direction.
So you mentioned earlier this idea of what's happening with the Mag 7, the Magnificent Seven stocks. Right? For the longest time, basically the market has been defined by one theme, which is, are you bullish Mag 7 or not? Right? What's so interesting is, the Magnificent Seven aren't really a monolith, or no longer a monolith, right? So 2025 was a really interesting year where there was kind of unprecedented dispersion across the different names in this category, with of course Google leading the way, and then Amazon lagging. Talk to me more about what happened this year, why this dispersion happened, and what does this portend for the future potentially?
I generally don't like to pin too much on even a 1 year's price performance, but I will say that this is one of the more important things that happened last year. If not, maybe it's one of the most important things that happened last year in terms of signaling that it's possible for this idea of a Mag 7 to sort of break down a little bit. Most of the Mag 7 names last year underperformed the S&P 500. And forever, there were many people who were committed to this idea that the whole stock market is being held up by the Mag 7. And frankly, for a period of time, that was true. But when you speak in those terms, the assumption is, well, if this narrative breaks down, then maybe the market starts to break down. But no, that's not how markets work. It is possible for a set of leaders to boost returns, but it does not necessarily mean when those companies lag that those returns start to lag. It's just all that means is that it may be an opportunity that the narratives start to evolve. But I think there are two really great lessons here. One, that you can have a ton of these trillion-dollar companies underperform and still have a market that does very well. And two, I guess sort of like getting back to the bubble talk, all right? One of the things that you do see or hear about with bubbles is indiscriminate buying, right? Just keep bidding up the prices with anything even remotely attached to whatever that theme is, whether it's .com or AI or whatever. It appears to be the case that the investor trader class was not indiscriminately buying AI stocks. They were picking winners and losers themselves. And so I think that makes for a very healthy, if not more reasonable market than something that's just insanely bubbly, which, again, speaks to my reluctance to try to time what may or may not be a bubble.
Inside of these bubble mechanics, there's this evolution that's going on too that I think is fascinating. I'm putting one of Kai's charts up here, so a little extra shine on Kai for coming up with this one. This is fascinating to me. You have these asset-light companies that have been growing like crazy, and they're now transitioning towards basically asset-heavy companies. Is that a negative in terms of them dominating the markets? What do you make of this evolution in really balance sheet composure?
Yeah, I thought, everyone should read Kai's report on this. Like this was a really a breath of fresh air in what has been a lot of sort of repetition in terms of the same narratives. But I think this is actually a really important story here. The idea that, and I guess it's sort of a general theme of our entire discussion here. We can never just think in terms of price and earnings. It's like you start from those points and try to dig deeper into what's going on. And when you have something like this, where we might be witnessing a major long-term structural change in terms of operating structure and capital structure at these companies, then the way you think about valuations and things like that need to evolve, because it's a lot harder to run a capital intensive company than a company that's run by a lot of people, putting code into the same computer. So beyond that, I don't think I really have too much to add. I think I'd like to hear Kai's sort of bottom line on this. But the only thing I would add is over the last couple of decades, every single one of these companies have evolved their business models and added businesses and gotten out of businesses. Facebook used to be a site where you click on your friends' photo albums, and now it's got WhatsApp and Instagram and all these kinds of things. Microsoft, everyone had to buy Office, but now they're in cloud and LinkedIn and Xbox and all this stuff, and it goes on and on and on. But yeah, the latest iteration of everyone building data centers and getting neck deep in hardware is something to absolutely be mindful of, especially when you're thinking about things like valuation.
Yeah, I mean, I think, Sam, you pretty much summed it up. I mean, I think, going back to my earlier point.
I summed it up only because I read your note, by the way.
Well, you did the most important thing, Sam, and you plugged me too. So, no, what I was going to say is, I think the main, this is the first thing you said, on this talk today was capitalism is all about competition. Right. And what made the Magnificent Seven so dominant, and perhaps will continue, but at least we can say with certainty looking back, was that they effectively kind of carved up all major digital services and said, hey, you two got this one, you two get this one, right? Basically creating this impenetrable oligopoly are built on network effects and IP, various digital moats that allowed them to earn really, really high returns on very little capital. Right? It doesn't require much capital to write code, and if you have the lock-in of the ecosystem, then the profits are all yours, which is incredible. Now, the concern is that these companies view AI as an existential risk, and as a result, they are saying, we're going to go all in on this new category, which we believe will collapse all markets into one. So whether you're doing shopping or search or chat or social media, it's all just going to be AI agents now, okay? And if that is the case, and that's their belief, it could prove being wrong, but the point is that they're operating under this assumption. Then what happens is the competition goes up a lot. And it turns out that the ability to build AI data centers is not like a unique thing that only Google and Microsoft can do. It turns out that Oracle, this legacy database company, can just say, you know what, like, I'm just going to roll the dice here, why not? And spend money it doesn't even have on building out data centers. It turns out that Bitcoin miners, that companies like CoreWeave, these so-called neoclouds, get into the race as well. So basically, there really is no moat, as far as I can tell, aside from the ability to want to spend more money when it comes to building AI data centers. And that's what concerns me, because we know the history of the railroads and the telecoms, right? They're basically utilities. Yes, of course, we all rely on this critical infrastructure. If the internet were to go down, that would be disastrous for the economy and for society. That being said, do these companies earn extra supernormal returns on capital? Not at all, right? They have to always be replacing their depreciating assets. There's obsolescence, there's wear and tear. Not great businesses to be in. So to the extent that we are potentially seeing the Magnificent Seven, rotate into what is, I would argue, a much worse type of business, that is concerning, just given the extent to which investors have been so conditioned over the past 15, 20 years to assign them these really elevated multiples on the basis of them having these kind of asset-like compounding machines, which they still have, but it's increasingly being diluted by what is more of a utility business.
Right. 100% agree. The one thing I will add is it's possible, it's very possible that this evolution in business structure can continue to go in this direction. And it is also possible that the investor class does wake up to this and decide that they're going to assign a different multiple that's much more conservative than what it is right now. Before everyone goes out and starts selling all these stocks, and this gets into sort of the broad philosophical discussion when it comes to stuff like PE ratios and whether or not they mean revert or whatever. Let's assume that they do mean revert. And let's say, for instance, these big tech companies see their PE ratios mean revert. Over what length of time, I'm not sure. But if during this interim period where they are their valuations get recalibrated, if during this interim period, they're still registering double-digit earnings growth, it is possible that you see them watch their multiples come down, 1, 2, 3 times, whatever, and still see the prices either go up or go sideways because the earnings are still holding up. I think this story is like one of the more interesting things, and it's going to be finance business school case for years to come. Because I think as quickly as people were happy to put huge premiums on earnings of these companies, if they continue to go in this direction where they get very capital intensive in this world where there's no moat, then I hate to say it, but it's gonna be really fascinating to see like Alphabet or whatever trade at 10 PE, and we'll revisit this on the podcast.
We'll revisit it, and I think of Apple however many years ago when you're looking at it on an adjusted cash basis. We have historic examples of like great, incredible companies trading at bizarro valuations, and that can happen again too.
Right. Yeah. I mean, in Kai's chart here in his report, it's funny to see AT&T on there. AT&T, once one of the hottest companies on the freaking planet. Like there wasn't a sexier tech company than big telecoms at one point, and now we inserted it into a chart to basically almost speak disparagingly of the hottest companies of today.
Yeah, we beat on them, and all those baby bells that came out of it. I mean, just
Right.
It's crazy to think about. I want to lightning round you through a few more charts from the deck that you put together, Sam. So let's just hit a couple of these because I think they are useful. Your quick take. Top 10 companies by decade. We're going to get this chart up on the screen. Top 10 companies by decade. It's supposed to change. It's supposed to turn over. Is there room for a paradigm shift here? Could we see this break?
Absolutely. I have a pretty high degree of confidence that in 2035, at least half of these names will turn over. I'm not sure what the other industries and sectors are going to look like. Maybe there's a world where AI replaces everything, but we also have a great distribution of wealth where we all, like, half of us are in the leisure industry. And Royal Caribbean becomes like one of the top 10. I don't know. But the lesson of history here is it's very difficult to predict what'll be the leaders in the future. But history also reminds you that the incumbents rarely stay there.
Wall Street price targets. Pointless exercise, fun bingo card to throw up once a year, best to forget after January 2nd when they're all stale.
Yeah, no, it's I've been reluctant to say this, but I'm getting more comfortable saying this. It's a pointless exercise. And I think increasingly it's getting out that even the strategists don't like this particular exercise. The only redeeming thing about price targets is it sort of helps you get a sense of a strategist or analyst bullishness or bearishness in terms of their interpretation of the fundamentals and what they are forecasting for fundamentals. The research notes that come with these price targets are actually I find to be quite interesting.
Those are the best parts. We did a episode just on a whole bunch of these for this year. I think we read 22 or 26 of them. But in every single one, because you see top line, bottom line, the profit margin projections, what they think the drivers are. Is the multiple going to change? Is it going to expand? Is it going to compress? What's driving that?
Right.
That doesn't show up in this chart.
It does not. It does not. It really is a shame because some strategists get a really bad rap because their price target is off, and then some strategists will have terrible research but somehow nail their number. I think one sort of anecdote I have here that I feel like is just factually just not covered is the chief strategist at Morgan Stanley, Mike Wilson, became really famous like 2 or 3 years ago because he was like the most bearish strategist in 2022 or something. And I remember at the time, I was following it. They send me his research and stuff, and I was reading through his note, and I thought the most interesting thing that he had to say, and this was end of 2021, early 2022, was he had this really interesting view on operating leverage and how companies restructuring and all these things during COVID. A lot of companies have refreshed in a way where just a little bit of revenue growth leads to a lot of earnings growth, and you're going to see profit margin expansion, all this stuff. So he had a really great intermediate term bullish thesis when it came to fundamentals. But the reason why he lands on a bearish price target was because of his view on multiple compression, as we often do. But yeah, we're looking back, backwards. And talking about things like high profit margins and where they've been and why they're happening, and it turns out one of the people who had one of the more compelling arguments for this and who's predicted this was a market bear 3 years ago. So yeah, I for my subscribers who are on some of these research lists, I tried to encourage them to look past those price targets because there are usually interesting things being said about the underlying fundamentals.
All right, I've got 2 more fun ones for you here. S&P 500 during the presidential cycle, 1950 year to date. We all talk about this stuff. We talk about who's in office. We debate them endlessly online. Obviously, in the midterm year, you go into another country and you take the president. This is included in all the data points here. This is a bunch of crap. Should we care about presidential cycle returns, or is it actually useful?
I generally don't care for 1, 2, 3 year seasonal patterns. Most of the time, and I'll tell you why. Most of the time, any way you slice historical numbers by certain years or certain months or whatever, it always comes out to either 70% or 90% of the time, the stock market still ends up positive, and so but you have these precision numbers. What's interesting about like this midterm stuff, and again, I think you still take it with a grain of salt, but you be aware of it, is there is a relatively consistent pattern here, and happens to be somewhat rooted in something that makes sense to people, and that midterm years are pretty uncertain from a policy standpoint, and so it's not crazy to think that as U.S. leaders are thinking about power dynamics later this year, that there is a lot of hemming and hawing about policy, and as a result, you get some policy uncertainty, and that just gives you force you to discount prices. So again, I don't think everybody runs to the exits, but this is just saying, don't be surprised if we are down 19% or something at some point this year before things inflect higher again.
All right, one more. This one's close to my heart because I think this is a enormously useful survey piece in the same way that the annual forecasts are, and I want to read the reports. This is the fund manager survey from Merrill Lynch. I love this because this is basically the boogeyman that we're all scared of. And so right now it's the AI bubble. 38% of correspondents are basically saying that's the biggest tail risk. Information like this, is it useful?
I think this is one of the great lagging indicators in that by the time a risk shows up here, it's usually either too late or it's confirmation that it's stale information. I mean, this is actually perfect, right? The fact that bubble is number one. That's not what you see in bubbles. Bubbles are when everyone says it's not a bubble and everyone's bidding stocks up. If you have 40% of the professional financial markets world saying this is a bubble, then it's probably not. My favorite example of how this top risk list has evolved was before March of 2020. Pandemics and viruses were not even on the top 50 of these things. And then they show up in, April, but that's when the market bottomed. So, and it was on that list for, another year until vaccines went on, we had inflation. But coronavirus dominated this list from, spring of 2020 into maybe late 2021. While coronavirus was happening, but that was also the best buying opportunity in recent history. So it's helpful in that, okay, it helps us understand what people are worried about, but yeah, it's either a combination of contrarian or stale or just an outright lagging indicator.
Beautiful, beautiful stuff. I'm going to thank you both. Kai, you go first. Would you just say the name of the piece that we pulled that chart of? Because you've been thinking so eloquently about this. This is why we wanted to make sure you were here with Sam today. What's the AI piece that you wrote?
It's titled Surviving the AI CapEx Boom.
Highly, highly recommend you go find that. Sparkline Capital is where you're going to find Kai, or look him up online. Sam, same question for you. Plug this piece that you wrote for Ticker with all these charts in it.
Yeah, I think it's called 27 Charts to Watch as we enter a new year. Every once in a while, I'll do these nice big chart roundups that sort of give you a nice cross-section of sort of my broad thinking in terms of markets. And, if anyone listening is interested in getting some free access, just reply to the free subscription email and let me know, and I'm happy to extend some comp months.
You know you want it, and Sam, you get bonus points for not doing 26 charts for 2026 or something dumb like that. I loved when that said 27. Take that, marketing brains. Fantastic stuff. Sam, we're going to have you back real soon. Kai, thanks for helping us today. You're watching Excess Returns. Like, subscribe, comment, all the things below, and we are out.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.